recording now. So once we're done with the expected cash that we need to pay for the purchases, next thing that we have to do is move to the next budget. Next budget is the direct labor. One thing you should know, from now on, it's getting easier because we don't have to do any more. We don't have to do any more with the beginning inventory, ending inventory. So for the direct labor, we have to prepare a detailed plan about showing the labor requirements on the specific time. That's the information that we're going to have. Again, I'm going to copy this information and I'm going to flip it to the Excel spreadsheet. Just give me a second to do this. All right, I'm almost done. Okay, let's share my screen now. And let's see what the question asks. Now, this company, each unit of production requires 0.05 hours or 3 minutes of direct labor. So again, our starting point will be the required production, which we already calculated. That's why the production is so important. Because after those numbers, when we get from the production, they go, first we're using those numbers for the direct material. Now we're using the same numbers for the labor, because this is the units that we need to produce. Obviously, the same number we're going to use for the manufacturing overhead. Because again, the product has 3 types of costs: direct material, direct labor, manufacturing overhead. For all those 3, we have to use the same numbers. So unit of production requires 0.05. So we can easily apply 0.05 here, 0.05 here, 0.05 here, and the quarter 0.05. So total hours that we need is 26 times 0.05. Those are the total hours that we need. Now, the company has a no layoff policy. So all the employees will be paid 40 hours for the work each week. What that means that if they won't call it 35 hours, we're still gonna pay them for 40 hours. If they work 20 hours, we're gonna still pay them 40 hours per week. Make sense?
Yes.
That means this policy. Now, in exchange for the layoff policy, workers agree to wage rate of $10, regardless of the hours worked, and no overtime. So what that means is, again, if the employee works 10 hours only per week, we're gonna pay the employee 40 hours. If the employee works 45 hours, we're still going to pay him 40 hours. So you see, in some cases you can win, in some cases you can lose. Make sense? Do you understand this?
Yes.
Say something. Yes, no, explain more. Are you guys there?
Yes. Yes. I can answer it.
Do you understand this no layoff policy?
Yes.
Okay, good. For the next 3 months, now for the next 3 months, the direct labor workforce will be paid minimum of 1,500 hours per month. So if they work less than 1,500, we're gonna still pay them 1,500. If they work more than that, then we're gonna pay them what actually work. Make sense? So let's see. We are applying this 1,500. 1,500. This month, total hours on 1,300. How much are we gonna pay them?
$1,500.
1,500. So the formula will be here will be equal to, let's do the formula here. That will be logical, and then we're gonna go if. Logical test will be if this number is less than that number. If that is true, then this one will be equal to that one. If it's false, then this number will apply. Make sense?
Yes. It's an if condition.
It's condition, yes. So there we go. In this case, 1,500. Next month, how much are we going to pay them next month? How many hours?
2,300.
2,300. Let's apply the formula, see if this works. 2,300. June, how many hours are we going to pay them in June?
1,500.
1,000. Let's see if the formula works. Formula works. Okay. So, what's the total hours here? Total hours here obviously will be one number. However, the hours that we pay them, it will be different number. Correct? So how much we pay them per hour? We pay them $10. So how much we have to pay in April? We have to pay this cell time $10. And I can drag this all the way to the end, correct? And get the numbers. No, actually not gonna be this. I have to log this $10,000. $10 here, I have to log this cell, and that will be more appropriate. Does that make sense?
Yes.
This one can be easily equal to those three. And all right, so we get the labor hours. Let's go back to the slides and see what the slide says. So we get the production. We get the labor hours required. Now we put the condition 1,500, which is our minimum hour. So the total hours that we're going to pay them is 5,300. Even though they work 250 hours less, we're still going to pay them 5,300 times $10, $53,000. So now the question is, what will be the direct labor cost for the quarter if the company follows no layoff policy but pays $15 time and a half for every hour work in excess of 1,500 hours? So let's go to the Excel spreadsheet and try to figure out this by ourselves. Can you see the question? Not yet, no. I have to share my screen. Can you see the question now?
Yes.
Yes.
So what says? What will be the total direct labor cost if for the quarter if the company follows no layoff policy? So they still applying this 1,500. Right? And for 1,500, they still paying $10. But for all the hours that they're working over $1,500, sorry, I'm confused. Just a second. Let's read it again. But for they're paying $15 or time and a half for every hour work in excess of 1,500. So what that means to us? So they still applying this. They still paying 1,500. However, for the 1,500, they're going to pay $10. And to everything over 1,500, they're going to pay 1.5, or they're going to pay $15. So for the month of April, how much they're going to pay?
The same.
Sorry?
It's going to be the same.
Okay, so let's go first. Is there any excess hours in April over 1,500?
No, it's going to be 15,000
That will
payment
be
total.
How are we going to get this formula? So let's put condition here. Condition will be formulas, and let's go logical. If this one is less than that one, if that's true, then it's 0. If it's false, then it will be this one minus that one, correct?
Yeah.
So if I flip this formula all the way to the end, the only month that I have excess over 1,500, which is our minimum, is the May. On May, I have 800 hours more. So for the first 1,500, I'm going to pay $10, right?
Yeah, 15,000.
Okay, so let's go. That will be equal to minimum paid time $10, and for the $10, I need to log this cell. So that's how much I'm going to pay. And for the anything excess, I'm going to pay additional $15, correct?
Yes.
So in only month that I'm going to pay additional, that will be the month of May. Make sense?
Yep.
So how much I'm going to pay in total? What will be our answer here?
57,000.
57,000. Let's go back to slides and let's see if that's actually true. Yes, that's it is. Again, how we're gonna check which month we have over. Then we're gonna get those on those 1,500. We're gonna pay $10, and the excess amount we're gonna pay 15, in total 57. So we are done with the labor. Now we're moving to the manufacturing overhead. For the manufacturing overhead, we're going to have this information. So let's copy this one and move it to the Excel spreadsheet again. Okay, so I'm ready. Let's move on. Stop sharing this one and let's move this one to Excel spreadsheet. So what they're saying is the company the company, overhead is applied to the units of production on the basis of the direct labor hours. So based on the number of direct labor hours, that's why we're applying the overhead. We have two overheads. One is the variable manufacturing overhead, which is $20 per direct labor hour. And we have the fixed manufacturing overhead, which is $50,000 per month. In that amount, the $50,000, we have a non-cash cost, which is depreciation. So first, what we have to do, we have to prepare the manufacturing overhead budget. We're starting again with the production. Now, since they're applying the direct labor, how much is our direct labor per, what was the direct labor that we knew using? 0.05 hours, remember? So here we're going to apply 0.05 hours to our production. And I can drag this all the way to the end. So basically, the total hours that I need is equal to this one times that one. Now I'm working with the actual hours, not what I'm paying them, correct? And here my variable manufacturing overhead rate is $20. So my cost, variable cost for April is that much, May that much, and June that much. In total, that much is my cost. Now, fixed manufacturing overhead cost. Every month is 50,000. That's why it's fixed, because it doesn't change from month to month. So I can drag this all the way to the end. So my total manufacturing overhead cost will be that much. Now, how much will be the cash that I'm paying? That's a different story, because I have an item here which I'm not paying cash. Depreciation, you understand, for the depreciation, we're not paying cash. Do you understand that? Do you guys understand that for the depreciation, I'm not paying cash? Can you guys hear me?
Yep.
Do you understand the logic for the depreciation I'm not paying?
Yes. Yes.
Okay. So I'm going to deduct the depreciation here, 20,000, in order to get the cash that I need for the manufacturing hours. So what I can see from here, my total manufacturing overhead for the month is 251, correct?
Yeah.
My total hours are 5,550, 5,050 hours. So, but this is on the budget side, correct? What we said about the predetermined manufacturing overhead rate. How we calculating predetermined manufacturing overhead rate? What was the calculation? Do you remember or you forgot? We're going to get the total cost, total estimated cost for the period. Make sense? And then we're going to get the total estimated total estimated allocation base driver usage for the period. When we get those two, I can calculate the predetermined manufacturing overhead. How much is my total estimated cost for the period? Because I'm doing the budget, correct? How much is my total estimated cost for the?
That's 251,000.
251. Or I can say here, this one is equal to that one. How much is my total estimated allocation-based driver usage for the period? First, what's my driver? It says here my driving is the applied for the direct labor hours, correct? So how much is the total labor hour that I'm estimating? Can you see the number here?
Yeah, it's 5,050.
So that will be equal to 5,000. So now what I have the nominator and I have the denominator. Once I have those two, let's go back because I don't like this. So once I have those two, I can easily get the predetermined manufacturing overhead, correct? Make sense?
Yep.
All right. So how much will be our predetermined manufacturing overhead then? That will be equal to, let's copy this one here, move it here, and that will be equal to this one divided by that one. And that will be dollar amount. Now we get our predetermined manufacturing overhead rate. So if you have to work later with that number, we have this number available. So let's move to the slides now. And let's see what the slide says. On this budget is, again, it's very straightforward. We get the budgeted hours, which are calculated by the actual hours. We applying getting the total cost. Now, once we have the total cost, which is the budget, and then we're going to have the total allocation base for the driver, which is 5,005, we can come up with the predetermined manufacturing overhead rate. Then we're eliminating the notification item, and we're coming up with the cash disbursements for the manufacturing overhead. At this point, now we have to calculate the finished goods inventory budget. What we're going to do now? We already know that to produce one product, we need 5 pounds. And the cost per pound is 40 cents. So the direct material for one product is $2. For direct labor, we know that one product can be produced for 3 minutes or 0.05 hours. And we're paying $10 per hour. So that's another 50 cents only per hour. From the manufacturing overhead, we already calculated, but for every single hour, direct labor hours costs us $49.70. So since we're using only 0.05 times $49.70, that's $2.49. So our cost per product is $4.99. So now we have the cost per product. The question is, what was our ending inventory in units? Our ending inventory in units, we can easily find it on the Excel spreadsheet. Let's go in the Excel spreadsheet and try to find it. Where will be that? That will be on the production budget, correct? If we look at the production budget, what's the desired ending inventory for the quarter? That will be 5,000 units. So let's go back to the slides. Since we know how much is our production ending inventory, which is 5,000 units, and we have the cost per unit, we can easily calculate in the ending finished goods inventory. 5,000 times 499, going to give you 2490. Next thing that we have to do is start doing the sales administrative expense budget. For the sales administrative expense budget, we need additional information. I'm going to copy this information, put it on the Excel spreadsheet, and I'm going to start sharing the Excel spreadsheet with you. Okay, I'm ready. Let's share this information now. So in this case, they're saying that the company sales administrative expenses budget is divided into the variable and fixed component. Can you see my screen?
Yes.
Now the variables selling administrative expenses are 50 cents per unit sold. So what will be our starting point? Our starting point will be the sales budget. Why? Because we pay variable per unit sold. So that will be 0.50 cents per unit sold. So how much will be our variable expenses? That will be 20,000 times 50 cents. We're going to get $10,000 and all the way to the end. Now, the fixed selling administrative expenses, including 10,000 in cost. I'm sorry, fixed selling expenses are $70,000 per month. So every month we have 70,000. So now our total sales and administrative expenses per month is that much, for the quarter is that much. Now, in the sales fixed selling administrative expenses, we have $10,000 cost, which is depreciation, which are not cash outflow. So in order to get the cash, we have to eliminate those $10,000. So let's eliminate the $10,000. And the cash that we need for selling administrative expenses, we already have the numbers. Now let's go back to the slides and see how the slides continue. Again, we're going to do this for April. And once we do it for April, let's see what's the question. What's the total cash disbursements for the selling administrative expenses for the quarter? Let's go to the Excel spreadsheet and see what's the answer for that one. So how much is the total cash disbursements for the selling administrative expenses? Should be $2,300, correct? Let's see if that's the correct answer. We have B. So let's apply B and see what's going to happen. Yes, B is our answer, and this is the calculation. Make sense?
Yep.
Now, so we're done with all the budgets for the cost. Now let's do the cash budget. Cash budget. Now he's going to get the information from all the budgets that we already prepared. Plus, we're going to need some additional information. So the cash budget is divided into the four sections. First section is the cash receipts, which are listed in the cash inflow, excluding borrowing. Second will be cash disbursements, listing all the payments, excluding the repayments on the principal interest. Then we're going to have a calculation part, which is cash excess or cash deficiency. And the final part will be the financing section, which is listing all the borrowings or repayments and interest. So in order to prepare the cash budget for this company, we need additional information. First, this company maintained 16% opening line of credit for $75,000. So they're paying 16% on the line of credit, which is all up to $75,000. Maintain, they need the minimum cash balance of $30,000. So at the end of the day, at the end of the month, they have to have minimum $30,000. Borrowing, when they borrow money, that happens on the first day of the month. But when they pay the loan, that happened on the last day of the month. Why is that? So we can easily calculate the 16% interest. Company pays dividends, $49,000 in April. So in our cash budget, we have to incorporate those $49,000. Also, company purchase $143,700 of equipment in May, and another equipment $48,300 in June. Both of those pay in cash. The cash balance for April 1st is $40,000. So I'm going to copy this, and we're going to move again to the Excel spreadsheet and start preparation of the cash budget. All right, pretty much done. Let's go and show my screen. This is one of the most interesting Excel spreadsheets that you have to prepare. First, let's start with the beginning cash. The question says in the beginning of April 1st, we have $40,000. So that's our $40,000. So what we have to do there? Then we have to add the cash collection for April. From where we're going to get the cash collection? Obviously, that will be equal to our sales. We're going to go to the sales budget, and we're going to see how much we collected in April, which is $170,000, correct? And that's how we're going to get cash collections. So if I drag this, I should get the same numbers. So let's double check this. 4,003. So 905 is my total. 905 is what I get. So the total cash that I'm going to have in April, May, and June is equal to those numbers. Make sense? Do you understand how I get the cash that I'm collecting? Can you guys see my screen? Are you guys there?
Yes.
Can you see my screen? Can you guys see my screen? Yes?
Yes, Professor.
Okay. So that's how we get the cash collection. So now disbursements. First, we have to pay for direct material. Direct material will be, we're going to go to direct material, we're going to see how much we have to pay. For direct material, we have to pay 40,000 in April. Then all those numbers, 72,300, 72,700. And we pay, on total, we have to pay 185. Let's see if that's 185. That's exactly how much is it. Then we have to pay for direct labor. Direct labor, we're going to get it from the direct labor. We're going to go down in here, and that's what we pay. 15,000, or in total, I'm going to pay, let's see if that's the direct labor, 53,000, 53,000 I'm paying for the direct labor. Next thing that I have to pay is the manufacturing overhead. Manufacturing overhead, I'm going to get it from the cash for manufacturing overhead. Total 191. Let's see, total 191. There we go, done. Next one, I have to get the sales and administrative expenses. In total, I'm paying 230,000. So I'm going to drag this, 230,000. Now I have to pay dividend. Dividend, I'm paying 49,000 in April. In May, there's no dividend. In June, no dividend. Next thing, equipment. First equipment, I have to pay it in 143,700 in May. So nothing in April. 173, or 143,700 in May, and here 0. Second equipment, 0 in April, 0 in May, but in June I have to pay 48,300. So I'm collecting $210,000. I'm spending $230,000. So at this point, I have deficiency for April $20,000. But I need to have, at the end of the month, minimum cash $30,000. So if I have, at this point, minus 20, how much I need to borrow to have the minimum cash, which is 30,000? Obviously, you have to borrow 50,000, correct? If I borrow 50,000, my ending balance will be 30,000. So I'm going to use this ending balance, and the ending balance for April is going to be my beginning balance for May. So when I run the calculation for May, I can see that I'm collecting cash $430,000. My deficiency is exactly $30,000. Now I have cash excess, $30,000, which is exactly the minimum required cash. So I don't have to do anything in May. I don't have to borrow, but also I cannot repay anything. Now, what's going to happen in June? Now, the $30,000 in May will be my beginning balance in June. So in June, I'm going to collect that much, but I'm going to spend that much. So I'm going to have an excess of $95,000. $95,000, so I have to keep minimum $30,000. So I have excess of $65,000. Can I repay my borrowing? Obviously I can, right? So let's pay this 50,000 first. And second one, I have to pay interest, which will be equal to that amount time. Now in bracket will be, we have 0.16 divided by 12, because that's for annual interest. 16% is annual interest. And that will be time, because I'm borrowing in the beginning of May, or beginning of April, all the way in May, and then paying and repaying back in end of June. So that will be times 3 months. So I have to pay interest of $2,000. So when I pay those 52,000, I'm 43. So I'm still over the minimum required cash. Does that make sense? Let's see what's happened with the slides. So the slides is going to go with 210. Then I'm going to have 230. My deficiency is $20,000. So I have to borrow 50,000 to come up with 30,000. The 30,000 ending balance here become the beginning balance for May. For May, I'm running the same numbers and I'm seeing that I'm $30,000. Exactly. I don't need to borrow because that's the minimum required cash that I have. So the question is, what's the excess deficiency of cash available over the disbursements for June? So to answer this question, let's go to the Excel spreadsheet that we just did. So in that case, the excess in June is $95,000. Let's see if that's the correct answer. And we have 95 as a possible answer. Let's mark that one. D, and D is the correct answer. How we get it? 95,000. So when I get $95,000, 95, that gives me 65 over the minimum. I can repay the borrowings 50,000 which I made in April, beginning of April, pay the interest for 1 to 3 months on the $50,000 at 16% interest, and I'm still going to have $43,000. That's my cash budget. Now the next thing that left is the income statement. Now the income statement, it's easy. Why? Because I have the sales. My sales, as from the sales budget, I'm getting the sales. Cost of goods sold. I already have the cost of my goods, $499. So I have the gross margin. I'm going to add the selling and administrative expenses. And when I deduct the interest expense, it's going to give me the net income. Once I do the income statement, then I can move and do the balance sheet. Now, for the balance sheet, I need additional information, which will be for the land, equipment, common shares, and retained earnings. Now, cash, the cash is 43,000. From where do I going to get the cash? From my cash budget, 43,000. So that's my cash. Then I'm going to have accounts receivables. Accounts receivables, if you remember, comes from the collection budget on the sales, which we calculated. Where's my sales? Here. And we said the $75,000 at the end of June, which will be collected in July, is my accounts receivables. Next thing. Raw material inventory. I already know that I have to keep 11,500 pounds, but the cost is 40 cents per pound. So that's how much is it. On the finished goods, we already calculate this number. 5,000 units, cost per unit is $499. I'm coming up with the finished goods inventory. I have the total current assets. From the information, I have land for 50,000, equipment 175. However, if you remember here, I purchased another 2 equipment for the total of 192,000. 192 plus 175, that gives me exactly 367 in equipment. And I get my total assets. Now, accounts payables this accounts payables is the 50% of the purchases in June, which we already calculated. Common shares, they don't change it, they're the same. The last thing that left is the retained earnings. On the retained earnings, we have to do the following calculation. We're going to get the beginning balance, which is 146,150. We're going to add the income, 239. We're going to deduct the dividend, which we paid in April, if you remember here, 49,000. What was that? Here, the dividend of 49,000 that we paid in April. And we're going to get 10 bars, 336,150. When we combine all together, we'll be in balance. And we're done with the balance sheet. Now, at this point, we have prepared a static budget. What means static budget? Static budget is prepared for only one level of activity, which is the plan or the budget level of activity. As you can see, our starting point was the particular sales number, and that's it. Now, these budgets are good for planning. However, if our actual sales are different than the number on the starting budget, we cannot use them for control purposes. For control purposes, we have to do a flexible budget. What is flexible budget? Flexible budget is prepared for the different activity level. And that shows the cost, what cost should be if we have this activity happen or that activity. So basically, in this scenario that we have, since everything starts from the sales, this is the numbers that we're using. So if our sales doesn't meet $20,000, we cannot use these budgets, whatever we prepare for the control purposes. For that reason, we have to prepare a flexible budget. Flexible budget means for April, we can prepare flexible budget for April based on the $10,000 sales, on the $20,000 sales, $30,000 sales. That will be different scenarios. Make sense? Are you guys there? I don't hear you. But for the flexible budget, we're gonna use the same logic that we use for the static budget. So basically, we're gonna prepare a budget for $10,000 for 10,000 machine hours. But if our actual results is 8,000, then we can see the variance, which will be based on the machine hour used. But since we're using less machine hours, obviously our cost will be less. But how this is relevant for us? Obviously, it's not too relevant because it's going to show us unfavorable variance on the machine hours used because we're using less, and favorable on the variable cost. Since we're using less, obviously the cost is going to go down. But again, for the control purposes, that's not very effective. So what we have to do? The question is, since the cost variances are favorable, did we do anything good on the cost side? Now, since we're using only the static budget, we cannot answer that question. We have to prepare the flexible budget. Flexible budget will be for the level of activity, for the exact level of activity which the actual results are. So, for example, to flex the budget, we need to know the total variable cost change, total fixed cost remaining unchanged. So, in order to do that, we have to understand this, that the variable cost change with the direct proportion of the change of activity, fixed cost remains the same. So now we're going to prepare a flexible budget for the different scenarios. First will be for the usage of 8,000 hours, 10,000 hours, and 12,000 hours. Again, the variable cost per unit, we're going to get it once we have the static budget. We're going to use the same logic on the static budget to prepare the flexible budget. So indirect labor cost, 40,000 divided by 10, $4. 30,000 divided by 10, $3. 5,000 divided by 10, that will be 50 cents. That's what we're going to use here. Now, for the depreciation insurance, fixed cost remains the same, so we're going to use the same numbers. Now we're going to start preparing for the different level of activity. For 8,000, 10,000, 12,000. For the 8,000, those will be the numbers. For 10,000, obviously, we have to run the new numbers for the 10,000. The question is what will be for 12,000? For 12,000 numbers is 104. So if you have to answer this question, the answer will be 104, which is this. Now, since we have those different budgets on the different level of activities, once we get the actual results, which is for 8,000 machine hours, we can actually compare the 1 hour budget with the actual results. So once we get the actual results, which are this, now we're going to start moving the cost. So now we budget for direct labor hours to spend $32,000. In reality, we spend 34. So that means we're spending more for the indirect labor. For the indirect material, we budget to spend 24,000, but in reality, we're spending 25,500. So again, for that one, we spend overspending. And for the power, we budget to spend 4,000. However, we're spending 3,800. So on that one, we spending less. On the depreciation, you can easily calculate depreciation is the same. On the insurance, we spend more, 50,000. Now we can do the variances. So the first variance will be on the, what was that? And the question here is, what's the variance in indirect labor when the flexible budget for 8,000 is compared to the actual results? So we can see easily, we're expecting 32, we're spending 34. So that will be 2,000 unfavorable, which is exactly this. Next question will be, what's the variance on the indirect material when the flexible budget for 8,000? So for 8,000, we expect to spend 24,000. In reality, we spend 25,500. So that will give us 1,500 unfavorable, which is that much. And for the power, we already said 200 favorable. So now once we have those numbers, now we can keep somebody responsible. So remember, on the static budget, we can only say how much of the 11 favorable is due to the lower level of activity and how much cost in control. So what's happened here? On the flexible performance, the static overhead budget of $10,000 and the actual $8,000 give us only the difference between the original and the actual. But if we want to do more analysis, we have to convert the static budget into the flexible budget and then to compare the flexible with the actual results. So from the static budget to the flexible budget, the difference will be level of activity. We can use it for the activity. But for the flexible budget and the actual, we can use it for the cost control. For the non-for-profit, that's different things are used there. So I'm not going to spend time on this. On the inventory decisions, those are very interesting things. On the inventory order cost, inventory carrying cost, cost of non-carrying sufficient inventory, how much are those? Now, economic production of lot size, setup cost, reorder points, load time, safety stock, all those things will be discussed with the students who are going to decide to continue with the accounting on the continuation of the managerial accounting. For the managerial accounting, for the EU on the introduction level, that's good enough for you.